Good morning. Today is October the 25th. My name is Neville Hornsey, market analyst for YouTrading, and today I'm joined by
Joel Frank, also market analyst for YouTrading.
How are you, Joel?
Nice, mate. Let's do it. Yeah, I'm all right, mate. How are you doing?
Yeah, Monday and Tuesday is going to be quite quiet in the markets. What was our biggest sort of key takeaway for this week?
Yeah, I mean, one key thing is to watch earnings because we're getting a lot of big tech names. So they're sort of spread throughout the week. So definitely keep an eye on them. It's like Facebook, Microsoft, Apple, Amazon, Google. Yeah. But yeah, like you say, things going to be relatively quiet today and tomorrow. But from Wednesday until Friday, things are very busy, really.
Yeah.
Like we can just jump straight into Wednesday.
All right.
Bank of Canada rate decision. They're going to taper the pace of their QE program, and then it's going to be closely watched in terms of their tone on the economy and their guidance for rate hikes, because money markets currently pricing in rate hikes from them in Q2 next year. So that could be quite sensitive. You seeing anything in the chart?
Looking at the dollar to start with, I guess. I was thinking more about last Friday, Fed Chair Powell talking about inflation being higher for longer, and we had the US dollar roll over, and then we were saying how I was thinking that's going to go a lot lower. And then for dollar CAD, the 89% of the retail traders for dollar CAD are long, so they're probably going to get stopped out around 100 pips lower. Right, what else have we got on the agenda?
Could be the Bank of Japan rate decision. It's going to be new inflation and economic forecasts. But to be honest, as always, Bank of Japan rate decision is probably going to be a bit of a non-event because everybody knows the Bank of Japan's not going to be changing or significantly tightening monetary policy for the foreseeable future. So that's going to be a bit of a non-event. So in my view, dollar yen is going to continue to be driven by mainly what happens with US Japanese rate differentials. So just look at the US 10-year, really, what happens with that.
Yeah. And we were saying that, if rates do go higher and the dollar yen does follow, then 84% of the retail traders on this platform, at least, are shorting the dollar yen. So they're on the wrong side once more. What else we got on Wednesday? We've done Canada. Do you talk about Australia? CPI.
No, we missed Australia. Yes, this one's a big one because we had Q3 inflation out of New Zealand, and that was much higher than expected. So we now, are we going to get the same out of Australia? But the big difference between New Zealand and Australia is in New Zealand, the Reserve Bank of New Zealand is hiking interest rates and they want to tighten monetary policy.
Yeah.
Whereas in Australia, the RBA is one of the most dovish banks in the G10, or one of the more dovish banks in the G10. They're saying they're not going to hike interest rates until 2024. But money markets are betting that they're going to change that stance because money markets currently pricing in a rate hike next year, by the end of next year.
Yeah.
So if that inflation is really high, we could see money markets pricing in even more aggressive from the RBA, even though they're saying that's not what they're going to do. So then we need to watch how the RBA responds to all of this. So a lot of potential drivers for the Aussie.
I thought this big red candle, the bearish engulfing, was a turn in the markets at this resistance level. But I guess a weaker US dollar is setting a precedent here.
Yeah, I mean, the other thing is, as long as commodity prices continue to advance, I mean, oil is higher this morning. Looks like metals have come off a little bit. Well, they continue to come off a little bit from recent highs, but the risks remain towards the upside for a lot of these markets. So as long as commodities are supportive, then the Aussie is probably going to continue to do well because that really is one of the key drivers for the Aussie. Like we can forget about the dovish RBA. If commodities are doing well, then the terms of trade for Australia, big commodity exporter, is going to be.
Yeah. Coal, obviously, I haven't got a chart of coal here at the moment, but coal's gone a lot higher, so much higher. It's not just gas and oil now. It's anything that you can burn to make electricity. All right. Thursday we've got euro news as well. So ECB.
Yeah, ECB. It was supposed to be a boring meeting. That was what the ECB, I think, had been hoping for, because December is when they're going to do their new forecasts and when they're going to do their official decision on what to do with the QE program after the PEP, the Pandemic Emergency Purchase Program, ends next March. But recent developments like the spike in gas prices, Eurozone inflation expectations have moved higher, partially as a result of that. Eurozone bond yields have been moving a lot higher. Money markets are pressing in rate hikes from the ECB by the end of next year, which is completely against what their guidance is. So we're going to have to, Lagarde is going to have to address all of that whilst also coming across dovish, basically. Yeah. So yeah, it should be an interesting meeting.
Nice one. Obviously, that happens, and then on this calendar, after the ECB press conference, then we get unemployment claims and pending home sales for the US markets. The last week's
and US GDP as well.
Yeah, but I'd say like last week's initial jobless claims came in a lot better, so that was good news. Yeah.
It appears as though well, it's a funny old labour market, US, at the moment. It's a lack of supply of labour. Basically, it's like the participation rate has dropped. People seemingly have either retired or they don't want to go back to work yet for whatever reason. And we're seeing that, and all of that equates to a lower unemployment rate, which equates to lower jobless claims, which is what we've been seeing.
That's good. All right, so then we get to Friday's core PCE. Obviously, Fed Chair Powell's been talking about higher inflation for longer, and you were saying that the PCE is their preferred inflation metric. So anything you want to add to that?
I don't think so, to be honest. I mean, basically, we know that inflation is going to be elevated. People are going to probably read in a little bit too closely in terms of like the micro details of the inflation report, as they always do. So you could see a bit of volatility. But yeah, like this, we were saying earlier, but there's US GDP on Thursday and then inflation on Friday. And if you are to see weaker growth than expected, but higher inflation than expected, that could reignite some of those stagflation fears, even though the US economy is not in stagflation, because demand-driven growth is still strong.
Yeah,
that's not stagflation. But still, when people talk about it, it can weigh on stocks, for example.
Yeah, and also when we talk about inflation, gold normally gets a mention as well. Gold's just touched over $1,800 an ounce again, and it looks like it wants to, at some point, go up and test the sort of triple top now, if you like, at 1830. And I was saying that if we don't get, or even if we do get above that, there's a big chance we get some liquidity and we come all the way back down to these double bottom here, because 1750 seems to be where a lot of the banks are buying or swapping out of their unallocated gold into the allocated gold. Obviously, the gold bugs are going to be happy as we look to be going higher today, at least.
We have seen the dollar been generally weakening against most of its major competitors in recent weeks, and that has been definitely a bit of a positive for gold. So if that continues, I don't see a reason why we can't test that triple top that you've got pointed out. Also, long-term US real yields remain subdued, and as long as that remains the case, then that's another positive for gold. So but if we do see the dollar really strengthen, then gold is done for.
Definitely.
Gold is heading for those lows that you pointed out.
All right, one chart, probably the last chart, because it is just a crazy chart. This US dollar versus the Turkish lira. Obviously, you're saying about President Erdogan. He's not happy, and the central banks having to do all sorts of crazy things as well.
Yeah, I mean, if you look at the last So what we are, monthly candles. Yeah, if you look at most of the depreciation in the lira that we've seen this year, most of that's been to do with the CBRT and the fact that basically Erdogan, he doesn't respect central bank independence at all. He's fired anybody that disagrees with him. What he wants is rate cuts, even though inflation's high, because he actually thinks that that's how you bring inflation down. It's not, but anyway, that's what he wants. So he's been firing any central bankers that don't agree with rate cuts, basically. So in the last 2 meetings, we've seen the CBRT slashing interest rates. They're right now at 16%, even though inflation is close to 20%, because usually you're supposed to, in the context of EMs, emerging market central banks anyway, you're supposed to have the interest rate above inflation. Like that's what you have in Russia and Brazil, or that's what they're trying to do in Brazil anyway. But they're doing the opposite in Turkey. And compounding all of that, there's geopolitical tensions as well. So people can read in the news this weekend, but Erdogan ordered the expulsion of a couple of ambassadors from like the US and France and countries
Germany
like
that.
No,
and for all the traders out there, there's a big old number 10 above, which could be a good target. That was quite interesting to say about Russia.
Yes,
I saw
think that is the.
I saw Russia was raising their interest rates still, so that's quite crazy. All right, is there anything else that we should be talking about?
I think perhaps just give a mention to keep one eye on fiscal spending negotiations in Washington, D.C. The Democrats seem to be getting pretty close now to a deal on the infrastructure and like the social care spending packages, which could be pretty large. I mean, they're spread over the next 10 years. So people say, 3 trillion over the next 10 years. I mean, 3 trillion is a lot, but yeah, spread over 10 years, it's only about 1% of GDP.
Yeah.
But still, it's still potentially a positive for risk appetite. So that's worth keeping an eye on.
All right, cool. All right, well, I hope you have a great week, and we'll look to see how these charts plan out.
Cheers, Neville.
Monday. All right, take care, man.